makers and market movers. This is The Pulse with Francine Lacqua.
A very good morning and welcome to The Pulse. I'm Manish Krenny in Dubai. Here's what's coming up on today's programme. A cluster of economic problems in China with the alarm bells ringing in the country's property and shadow banking sectors. European stocks are lower. Global bonds deepen their slump on concern over higher rates in the US. Most Fed officials saw significant upside risks to inflation, even as two favoured keeping rates unchanged at the last meeting. Plus, UK inflation falls but remains higher than expected. We discuss with Santander's chief UK economist on Bloomberg UK. That is in 30 minutes. So let's just break some news for you from Norway. Yesterday we spoke to the head of the Sovereign Wealth Fund there. He's concerned about climate and inflation, and indeed the central bank raised rates again to 4%, up 25 basis points. We are far from done in the global rates narrative. Yes, the Aussies might have run out of puff, but for the Norwegians, deposit rates go to 4% from 3.75%. So keep an eye on that, checking in on where we are. The Norges Bank raises rates, as I say, to 4%, pretty much in line with where the survey was across the Bloomberg world. In terms of European markets this morning, this is a much more tenuous let's say, situation. Global bond yields are at a 15-year high. That is having an impact across the entire equity spectrum. You've got the Fed talking about further tightening. You've got intervention potentially on the watch in the yen. You've got Japan under pressure in that regard. The bond auction there was fairly awful. We'll talk more about that in just a moment. Combined with that, we're on intervention watch in China. The question for European markets is, of course, how bad is it in China? What are you more fearful of? Just step back for a moment. What are you more fearful of? Are you more fearful of a more aggressive Federal Reserve or of a major implosion in China? That is what you must ask yourself this morning. Now, there's an additional line coming from the Norges Bank. They see rates raised further in September. They are not done raising rates. Let's just check in on euro stock, euro krona, and this is what we got for you in terms of the FX reaction. You know what, let's just check in across the assets here. As I say, they're far from done. That is the red headline from you from Norges Bank. There will be more to come. When it comes to this story in the bond markets, what you have really here is, you know, the Fed. Further tightening will come. Yes, they were unanimous, but there were two people who felt that maybe they should hit the pause for the moment. Let's switch back to the euro krona. As you can see, there is a pretty important reaction there, which is a strengthening in the krona, a drop in the euro. This is on the guidance that the Norges Bank not only has raised rates to 4%, which was in line with consensus, but it is also about the guidance going forward in terms of September. And that is what you really want to keep an eye on, because, of course, not all central banks are built of the same timber, so to speak. They see raised further in September. That is your red headline. Let's have a quick check on the housing market and the slump. Are we going back to the cross-asset board? I think maybe we've already given you that. Let's talk a little bit more about China. I said to you, what are you more fearful of as you look at risk this morning? Of more malevolent story coming from China, who are defending the currency, or of a more aggressive Federal Reserve? Well, the housing slump is one of the key focuses. It's certainly worse than the official data is showing. That's according to the property agents and the private data providers. Government data shows new home pricing slipping 2.4% from a high in August 2021, with existing homes down 6%. But the private figures show existing home prices slumping between 15 to 25%, adding to the nation's woes. Bloomberg has learned that the Chinese shadow banking giant is planning a restructuring in its debt. They have hired KPMG to conduct an audit of its balance sheet. My next guest says that China confidence is deeply damaged and that stimulus is unlikely to be large enough to turn the situation around. Aneeka Gupta is my guest, Director of Macro Research at Wisdomtree. Oh, ye of little faith, Ms. Gupta, how are you doing? So you lack confidence in China, and we're seeing record selling on the Connect. I mean, are you completely devoid of China, Aneeka? How do you look at the spectre of intervention and stimulus right now? Good morning.
Very good morning, Manis. So, I think we're in a period of a long, slow grind for the Chinese economy. Yes, we're likely to see piecemeal stimulus, take place on the back of further weakening of economic data. But our view is that's always going to fall short of the amount of stimulus they need. And it's very difficult for China at the same time because the currency is weakening. We've seen the renminbi fall, and that's a sign of the economy not faring as well as market investors expected at the start of the year. So that's another cause of concern, even though they have enough room to stimulate because inflation is extremely low, bordering on the line of deflation. Yet the fact that the currency remains weak will warrant them having to intervene in the markets, and hence they're caught between balancing the economy as opposed to managing currency risk, with the currency falling even further.
Well, here's the debate, isn't it, on the currency side? The currency is supposed to act as that release valve. In theory, that's what it did in the UK when we imploded in the UK in the latter part of last autumn. Here we are, the currency's under pressure. I've got the PBOC. We've got a spectacular chart, 918 basis points of a harder fixing, a stronger fixing from the PBOC. I mean, this is virulent intervention and sending a message. Why do you think, is it because of the speed of the change in the currency that has unseated them, unnerved them? Because surely in a deflationary environment or the spectre of deflation, they would welcome a lower currency.
You're absolutely right. Given the fact that they are a strong export-based economy, a weaker currency should benefit. It should benefit the Chinese economy. But that's up to a certain point. It's reached a point where it's actually to the detriment of the economy, and it's actually reflecting, the underlying weakness within the Chinese economy. And hence they need to arrest that weakness at this point in time and stem further losses.
Global bond yields are at a 15-year high. It was a pretty awful time about 15 years ago. You may well recall we had a few problems with subprime. We had some small malevolent issues like Lehman's, etc., Fannie Mae, Freddie Mac, the list could go on. So yields are back at levels that we haven't seen in 15 years globally. Is that something that will tempt the world, his mother and his wife, and every single asset manager to step in now? Or is Larry Summers right and that yields have a further trajectory to the upside of 4.75%? Would you step into bond duration at this juncture? What does the flow show tell you?
So, the flows are where the investors' view really lies. If flows are telling us that investors are essentially pricing in, they're embracing duration, investors are positioned for recession, an inflation crash, and Fed cuts. And that's clear because we've seen $31.7 billion of inflows into Treasury bond ETFs. Now, our view is we expect rates to remain higher for longer. So we don't expect to see Fed rate cuts until the end of Q1 of 2024. And the reason for that is we're facing a much more resilient US economy. And hence, even if you look at the recent data of this week, be it retail sales, be it, the Atlanta GDP tracker, those numbers are, conveying a much stronger US economy.
I love what you say. There is no alternative. I mean, we murdered that phrase last year, didn't we? We've murdered that a few times. There is no alternative to equities. However, with these higher bond yields, does it get harder, Aneeka, to stay with the TINA? I know we've come from the lows in equities, but like S&P's given back nearly 5% this month. Nasdaq's down a couple of percent, nearly 5% over 10 days. Looking at bonds to equities, is TINA in the emergency room?
So looking at bonds to equities, clearly equity risk premiums have come off. The correction that we've seen, we've been calling for a correction in the markets for a while, and it's a healthy correction. Think about it. For the first 6 months, no one has really had an opportunity to get into the markets because it's been a straight run up. So we are seeing this correction. It's a healthy correction. I think it's inevitable. We're also in the period of August where trading is relatively thin. But I think from the perspective of what bond yields are telling us, they're telling us that that narrative of aggressive rate cuts, inflation falling flat, doesn't exist anymore. We're likely to see bond yields trading higher for longer. We don't see it hit. We don't see the 10-year hit the 4.7% mark, as we expect. Monetary policy does work with lags. So while the U.S. economy is extremely strong at this point, we could face a slowdown along the line in a few months forward, and hence we're likely to see yields remaining higher at this point in time, but not moving past that 4.5% level.
Okay, well, Stephen Major, yesterday, very strong note in terms of it's time to step in, pick up duration at 4.2%. Aneeka, thank you very much. Great coverage this morning. Aneeka Gupta, the Director of Macroeconomic Research over at Wisdomtree. So that's state of play in terms of Tina might be in the casualty room as your alternative to equities. We're going to catch up with the Deputy Governor of the South African Reserve Bank. A deep dive into monetary policy in South Africa, right here on The Pulse. The conversations that matter, the insights that you need. It is The Pulse. I'm Menace Cranny in Dubai. Well, the frontrunner for Argentina's presidential race, Javier Milei, is pledging to close the nation's central bank, but says he'd make every effort to avoid a default on the debt. In an exclusive interview, he told Bloomberg that his plans include making the US dollar the official currency of Argentina.
I think there's a previous discussion about dollarization. Actually, strictly speaking, it's to get rid of the central bank. The dollarization is an instrumental issue at the end of the day. There are four argumentative axes. One has to do with a moral issue, which is that stealing is wrong. And seigniorage is nothing more or less than a swindle by politicians against good people. Therefore, let's say if we consider that stealing is wrong, one of the greatest thieves in the history of mankind is the central bank. The second point has to do with a technical issue, because in the Argentine case, it is more evident when a product has no demand, its price is zero. So, if the local currency has no demand, and its price should be zero, the equilibrium real balances are zero. Whatever amount of money a central bank wishes to impose, the counterpart is that the price level is infinite. Demand and its price should be zero. Equilibrium, real balances are zero. Whatever amount of money a central bank wants to impose, the flip side is that the price level has infinity.
And what do you do with the central bank? Would you close it? At one point you made the joke that you were going to set it on fire.
Well, what you do with the building is a problem of what you decide to do with it. It's a figure, it's a metaphor. What I'm saying is that the institution doesn't exist anymore. I am saying that in the transition, until you can transform the banking system into a free banking system, it will have to fulfill the function of regulating the banks. The superintendent of financial institutions will continue to operate until a free banking system can be set up.
And in that idea, if you are president in 6 months, 10 months, 1 year, all the bills in circulation in Argentina would be dollars?
All dollars, yes.
Punchy conversation there, an exclusive conversation with the Argentinian presidential front runner, Javier Milei. Coming up on the show, Argentina, as we've just said, talking about the country's central bank, but we're going to have a conversation next with the future leader of the Central Bank of South Africa, right here on Bloomberg. It's the conversations that matter, the insights that you need on The Pulse. I'm Menace Cranny in Dubai. Fed officials at the policy meeting in July largely remained concerned about inflation, that it would fail to recede and that there would be a need for further hikes. Meanwhile, in South Africa, food prices increased at the slowest pace in at least 9 months. That's according to the Bloomberg Barbecue Index. Now, the cooling is a vindication of the central bank's decision to leave the benchmark rate unchanged after the overall inflation level slowed. So let's welcome Fundi Tshazibana. She is the Deputy Governor of South African Reserve Bank. Deputy Governor, welcome to Bloomberg. We should rechristen that, shouldn't we? The BRI index. But the BRI index is down. Food inflation has cooled. But I look at the world. We have El Nino, with the Black Sea deal failing. There are real risks on the food front for South Africa. How concerned are you that food inflation and inflation has been tamed or is in the process of being tamed in South Africa? Good morning.
Good morning. We're cautious in the same way as you're seeing other central banks around food prices. For us in particular, even though global food prices have moderated significantly, our food prices have been lagging behind, largely because of currency-related risk. But at the same time, we're recognizing that there are these risks that are there in the outlook. And those do relate to El Nino, so one does expect to see the sharp change in weather patterns towards the end of the year. And so this is something that we're very cautious about, and we've continued to highlight it in our July meeting that we've had of the MPC.
Look, the central bank has paused 8.25%. We're at a 14-year high. The question I have for you is, are we in a solid pause period? When you look at the inflation data, would you be a supporter of a solid pause in the hiking cycle for South Africa?
We've been very clear this is not a solid pause because the risks remain significant. So if one looks at June inflation numbers, our our headline number was 5.4%. But within that 5.4%, food price inflation was 11% still. So very much still at double-digit levels. We've highlighted a number of risks that are related to the sovereign risk premium, and this is an area that continues to drive our decisions. So there are a number of vulnerabilities and risks that we're seeing. Electricity is another one that we've also flagged, which is feeding into underlying prices as well in the economy.
I mean, you talk about electricity, the problems with Eskom. I've been interviewing about Eskom for as long as I've been at Bloomberg. It's been a problem for South Africa, outages. It's not growth by 2%. So far this year. Do you expect these outages to improve? Do you expect it still to be a significant drag on growth and confidence on the currency?
Yeah. So the outages had certainly improved during the winter months, and it's largely because we don't have the planned maintenance. The test is really going to be in the second half of the year. As the planned maintenance goes forward, however, we have received assurances from the Minister of Electricity around some of the planned maintenance to ensure that we're not going to have several power stations that are out and not fully functional at the same time. We are also seeing investment by independent power producers taking off as well. We also are seeing additional installations by households and businesses of their own alternative power solutions, which would likely help to moderate the impact. Having said that, the confidence effect is really important and significant, which is why for us, it will be really key to ensure that by 2025, we have a lot more certainty that we are going to have energy security. Very key for investment, very key for ensuring that we will have potential growth improving over the next while and employment prospects improving.
What about rates at this level? You know, we are looking at interest rates at 8.25%. Are there cracks in the consumer? I mean, the long variable lag. How do you see the consumer behavior at the moment in the mortgage market and the overall consumption?
We certainly are seeing, if one looks at non-performing loans by banks, we have seen a sharp increase in those starting from the second quarter of last year. So the pain is coming through. And this is something that we recognize as a central bank, is that when you are making an adjustment during the inflation cycle, towards having stable prices, there does come pain for consumers. And it is there, it's very visible. It's visible when one looks at household spending numbers. We're expecting household spending to only rise by just over a percentage, just 1% in this year. And that's certainly not an economy that is firing up and charging going forward.
Deputy Governor, always great to get insight on the nation and the finances there. That's Fundi Tshazibana, Deputy Governor of the South African Reserve Bank. We started the show with a proposition for you. What are you more concerned about? A deep implosion in China, which is unfolding on a daily basis, or a much more aggressive Federal Reserve? Yields are rising. 10-year paper trades at 4.25%. Do you believe, as Stephen Major does, this is a moment to step into duration? Nomura do not. There is not enough term premium. Nor, for that matter, does Larry Summers. He believes that you're on your way to a new era in bonds at 4.75%. Aussie rates tanked to a 9-month low. Unemployment rates are rising to 3.7%.